Those were the top headlines that we're tracking for you from the startup world. But on what's brewing today, venture debt in India is on the rise, with total funding reaching $1.2 billion in 2024, marking a 30% year-on-year growth. As equity funding slows down, dropping 45% last year, most startups, especially in the SaaS and fintech, are turning to debt to fuel their expansion plans. This, as per the global venture debt report launched by Stride Ventures in collaboration with Kearney. What are the key drivers behind this growth, and can we expect the momentum to continue in 2025? My colleague Aishwarya Anand finds out from Ishpreet Singh Gandhi, founder and managing partner at Stride Ventures. Take a look.
Venture debt overall, if you've seen the trends, what we were telling as well, it was less than 100 million in 2018, and now it's 1.25 billion. So this is almost 13x growth in like 6 years. Look, I think it naturally will grow, not to that percentage growth. Okay. So venture debt will grow as ecosystem keeps on reviving more. Because I think there was a time when venture capital and private equity ecosystem has been slightly subdued in the last 2 years, if you've been seeing that. So venture debt will start growing. Also, what will grow is growth debt, growth stage debt orientation. Because there are a lot of tech companies who are going towards listing. Okay, when that happens, another use cases emerge that you're doing a pre-IPO round. Can you substitute that pre-IPO round with debt? You are doing some asset-heavy businesses and the scale is becoming bigger. Can you substitute that with that? You're trying to acquire smaller companies. Why you have to dilute so much for acquiring smaller companies? So you substitute those. So venture debt will just extend itself a little bit towards growth debt, and I think that's where the growth will happen more. Traditional venture debt will keep on growing. Maybe not be that percentage, but definitely should grow.
Okay. You mentioned the pre-IPO round, and the report does mention that Ola Electric and Bluestone, they used venture debt before, going for listing. Could you elaborate on that a little bit? Do we actually see that emerging as a very, very big trend now going forward, that, companies who want to go for a listing, they will start depending a lot on venture debt fund to strengthen their financial, to strengthen their balance sheet, to optimize their capital requirements? How will it work?
The companies you mentioned, again, they were doing pre-IPO rounds, or they were at this clear juncture of going IPO. So when you're very clear about the IPO side, you would want to dilute less because in public markets you'll get better returns. Correct. So for existing investors and founders, to create a structure which helps them prevent less dilution at pre-IPO rounds makes sense. And you have a defined use case, right? Pre-IPO round, you're trying to get enough growth capital that till the time you're going IPO, you're well covered, even if you linger IPO, which has happened for some of the companies for a couple of quarters, and you're well capitalized for the expansion. So typically you have now in India a pre-IPO market, which was never there. At least a couple of years back, it was not as big as what it is today. So I think that use cases have emerged more.
In terms of sectors, what is making fintech, consumer tech, very lucrative for venture debt funding? And, in 2025, could we see more emerging sectors where venture debt could play a big role? Do you see that happen?
The reason fintech has emerged as an important sector because government has got a very good infrastructure, right? Individuals, we have Aadhaar-enabled credit now. Businesses, we have GST-enabled credit now. So the fintechs are emerging on the top of the government infrastructure. That's why the sector has progressed well, and the use cases within the sector has progressed well. And if you see consumer, it's a similar case, right? Government is concentrating on healthcare infrastructure. Right? There is naturally a talk about AI. Correct. People are saying, how can we become a tech-oriented infra if other countries can do it? So these are the two sectors, healthcare and an extension of tech. I don't want to call it AI because AI is the buzzword, naturally everybody's aware. But at least innovation coming in an infrastructure manner which will present more companies and hence present use cases.
Now talking about Stride, you've made $500 million across 100 plus companies in the last year. Committed $1 billion, right? So this year, how many investments are you looking to make? What are consumer tech, I think clean tech and deep tech have been one of your key focus areas. So beyond that, what are the sectors that you're looking at?
Look, clean tech has been an important stay for us for the last 2-3 years. And that sector has kept on propelling well alongside consumer and fintech. We'll still think that these three areas will remain important. So 60 to 70% of our deployment has been these three sectors. We think that it will remain same in the next, at least in the coming year.
One final question. So US venture debt market was 5 times larger than India. So I want to understand what are some of the lessons that India could take from mature venture debt ecosystems and incorporate? And by when do you think we'll reach that scale?
The learnings is from the credit perspective will be to make sure that you do products which are non-traditional products. You do very founder first kind of products. They work very cohesively amongst each other, venture debt, venture credit. And one of the reasons for growth is very accepted. Founders have got, for them it's very generic and the first thing to use in their mind. It's very accepted of form, which has gained in India. So I think those learnings of ensuring that the first word of venture debt being equally taken in the breadth of venture capital comes in.
Well, moving